What is this depreciation recapture on my property? Welcome back to the Retire with Peace podcast. As always, I'm your host, Dave Zagel.
Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
We get this question a lot. Well, I shouldn't say a lot, but often enough. We get questions on what is depreciation recapture. Some people are aware of it, which is nice. Other times, people might come to us looking for help, and it's about selling a property. Doesn't matter really what it is. You can pick any property. And sometimes there's a surprise on what the tax implication is. So I want to go over that. Not that it's good or bad, because there's benefits to this, but it's important to understand if you're owning really any type of property. It doesn't matter if it's a duplex, single-family rental, vacation property, office building, you name it. If you have any of those investments, what you have purchased needs to be depreciated over time. And for those of you already thinking in advance, we're not covering cost segregation or anything like that. We're keeping this simple. Just understand that if you have a property, it actually must get depreciated over time from a tax perspective. Now, there's a benefit to this, which is each year you get an expense to offset the income of depreciation on that property. A lot of times, this is a great tax benefit that helps lower your tax burden in those years that the property is operating. That's great. That's the good news. You get this deduction. In fact, you have to take this depreciation deduction. It's required, but you get to offset your income with this depreciation expense. So if you buy any building for $300,000, depends on what type of property it is in terms of how much you get to depreciate, but you're going to get a couple $1,000s at least of depreciation each year from that property. That's the good news. The challenge is at the end, when you sell the property, you have what's called depreciation recapture. Now, there's some ways around this. Again, we're keeping this simple. But understand you could do what's called a 1031 exchange if you wanted to exchange into a different property. We're not covering that right now. We're just talking specifically about depreciation recapture and what happens if you simply sell this property. So let's stick with our example of $300,000. I threw that number out there. Let's say $300,000, and we've held this property for a long time, decade, 2 decades. So let's say we bought it at $300,000. But we've depreciated $200,000 now. And so we've gotten that $200,000 of depreciation expense over time, which has helped offset our income over time, which is awesome. Now, when we sell it, we have to do what's called depreciation recapture, which means that $200,000 of expense that we took over time now gets recorded as ordinary income in the year that you sell it. So when you sell it, you could have both a capital gain and depreciation recapture. Remember, we bought it for $300,000. So let's say we sold it for, we held it a while. Let's say we've sold it for $600,000. We have that $300,000 capital gain because the value has gone up. And most people are aware of that piece, but that's the capital gain. But then we also have this depreciation recapture where all that depreciation we took for several years now comes back as ordinary income in the year that we sell it. That's the bad news. So it's not that it's good or bad. It's just what the rule is. You got to take that expense every year, and that was the benefit. Now, if you sell it, you have to record ordinary income as depreciation recapture on that property. Again, not necessarily a good or bad thing. That's just what the rule is. And it's important to be aware of that rule because that changes a lot of decisions. You may not want to sell it outright. You might want to do a 1031 exchange to a different property. You might just want to hold that until you die. Because whenever you pass on that asset, it gets what's called a step up in basis. So, let's say you died and it was worth 800,000. Well, that's the tax basis. Nobody's paying tax on any of that gain. Whoever's inheriting it, that inherits it at that $800,000 level when you pass away. So again, that's another way you can avoid this tax. But it's not necessarily that you always want to avoid selling it and avoid that tax. You have to just build that into the plan for planning purposes. If you do decide to sell it outright and take the money and do something different with it, that can be fine. It's just important to understand what that tax impact is before you even consider making that decision to sell the property, because you're going to have the capital gain on how much that property has appreciated, but you're also going to have the income from that depreciation recapture. Again, not necessarily a bad thing, but if you don't plan around that, you can get quite a big shock. It can have a lot of impacts on your tax return and tax planning if we're not aware of this and planning accordingly for it. So keep that in mind. If you're investing in real estate, you need to understand what that depreciation recapture is, especially if you've held the real estate for a long time and you've been depreciating it for a long time. It's going to have a big impact, not necessarily the end of the world. We just need to make sure that it still makes sense to sell that property and do whatever else you're going to do with the money. And you need to understand that really before you get into the process of selling, because if it's not going to make sense from a planning perspective, you need to plan accordingly to keep the property and figure out what to do with that or exchange it to a new property. So that is depreciation recapture in a very short explanation, but it's just important to understand if you're investing in real estate or if you're going to invest in real estate, understand that at some point, if you sell that property outright, you're going to have a piece of depreciation recapture that gets taxed and you need to plan accordingly.